So why don't we go back to the beginning? Tell us about you, a younger Hamish, where you grew up, if there was any one in particular or a book or some type of mentor that you had that sort of set you on this journey towards investing.
Yeah, well, I was always interested in money, and I don't want to say that badly. I was very interested in the mathematics of money. I really like math. I went to University of New South Wales. I started out studying combined law degree, finance and law. The law didn't have a lot of interest in me, so I dropped the law and took up a double major in finance and accounting, and really was keen to get out of the sort of academic world as quickly as I could. And I actually started at a company called Schroders Australia, and I started really on the M&A side. I really wanted to be a banker, an M&A banker. You know, grew up in the 1980s. I guess we all watched Wall Street and those type of things. So I wanted to get in the M&A game. And on the day I arrived at Schroders Australia, I was incredibly fortunate that on the same day I joined, a gentleman called Chris Mackay joined Schroders Australia. And Chris is a bit older than I am. And the chief executive of Schroders, a man called Peter Mason, actually had a lunch for us in the boardroom, and I was this bright-eyed graduate. And then Chris and I went and sat next to each other for the next sort of 4.5 years at Schroders. And on that day I joined, he put 20 years of Berkshire Hathaway annual reports on my desk and said, I guess you should read these. And I sat down and I actually read them all, and I was absolutely fascinated with the whole Buffett philosophy. And then I went searching out for sort of the Buffett influences, what had influenced Warren and Charlie Munger. And of course you come to Benjamin Graham, security analysis. You come to Phil Fisher. Both very, very important in different ways. So I really was influenced really by Chris to start with, but then I was very, very influenced by the whole Buffett, Munger, Graham, Fisher view of the world. So even though I didn't know any of those gentlemen, I've met some of them subsequently, obviously not Ben Graham and Phil Fisher because they're no longer around. But I was hugely influenced by the eminent dead or by people I had never met before. And I have a lot to thank Chris for that very early influence, literally on the first day I started working. And then Chris and I, of course, went to many Berkshire Hathaway annual general meetings together, and I met Brett Cairns, who's now our chief executive, and he used to come to the Berkshire Hathaway meetings as well.
Do you still get to them?
Yeah, we do. Brett was there this year. I went a few years ago. I try and get there, but you know, you get them. You get the podcasts and you get the live stream pretty instantaneously. But sometimes they remind you about things. They were more interesting when the meetings were much smaller, to be honest. And I will often go back and I'll be at the gym and I will go and say, let's listen to the 1998 or the 1996. Annual general meeting, and I do that quite a lot, and I re-listen to all the old sort of meetings and go back and read writings. Most of them I'm pretty familiar with.
Is that something that you do today? Do you indoctrinate some of the analysts with the 50-year, I suppose, anniversary textbooks, the Buffett and Munger, textbook to investing? Here you go, take the annual letters and go away and read that in your own time, or is that something that you do with your analysts?
Well, we've got a lot of the Buffett stuff around and security analysts. So people know the background and philosophy, but we've developed our own investment philosophy. So while we're influenced, we do things that are quite different to what Warren and Charlie are doing at the moment, and we're in quite a different gear to the gears they're in. You know, I write a lot about our investment philosophy over time. I'm actually just writing another piece that's going to come up in our annual letter as well. I don't force our analysts to read what I write, but there's a lot of other things that are sitting around Magellan that aren't just old Berkshire Hathaway annual reports.
So, okay, we'll get to your investment process and philosophy in a moment, but perhaps you could take us through that next step in your career. Where did you go from Schroders?
Yeah, well, Chris and I actually left Schroders in end of 1994, actually.
Okay.
I'd started
You left
in
together?
19. We left together. So I joined on the same day with Chris, and we were hired by a company called Potter Warburg that became UBS. Chris went on to become the chairman and chief executive of UBS in Australia and New Zealand, and I was very, very fortunate that I got to meet a man called Tony Burgess. Tony Burgess is a brilliant person. He was head of the sort of investment banking side of Potter Warburg, based in Melbourne, and I actually moved with my wife just after we got married from Sydney to Melbourne. And I worked with Tony, and then Tony and I and another gentleman called Jeff Cohen, we actually left end of 1995. We left Potter Warburg, and we joined a company that was 40% owned by Rothschild called EL&C Baillieu. And in the end, that business, I became a partner of that business at a fairly young age, and we ended up selling that business. We bought Rothschild out, and then we sold EL&C Baillieu. A bunch of partners there. It was led by a gentleman called Clive Smith, who's a wonderful person. It was bought by Deutsche Bank.
Okay.
And in the end, I joined Deutsche Bank, I think it was in 1997, and I left Deutsche Bank in 2006. I was ending up the co-head of global banking, which is their investment banking business here. So I had a career of 16 years in investment banking and had a wonderful time, met some incredibly smart people, did a lot of advisory work for some of the world's largest companies at a very young age. And then Chris and I, when we left investment banking, I think had done 8 of the top 10 deals, largest deals that had ever been done in Australia between us. So we were very, very fortunate. But investing was in our blood at the end of the day, and Chris had already stepped down and had a small investment company called New Privateer. And I said to Chris in early 2006, why don't we set up a funds management business? And he said, it was just after my father died actually, and he said, it's a great idea. I happen to have already left UBS, but if you manage to get your act together and leave Deutsche Bank, I'd love to do that. And that was kind of the genesis.
Why did you want to move into funds management?
Well, Chris and I had been for 16 years debating investments. We'd been doing a lot of personal investing. We'd been going to Berkshire Hathaway. He had already stepped down, and we just had a passion in the space. So we thought we'd give it a go.
And so, how did you seed the business? Was it just the two of you? What was Magellan like in the formative days?
Well, we did something pretty unique when we set the business up. Chris and I wanted to have something set up for scale, and we decided to do it as a listed company. And what we did is Malcolm Turnbull had a company called Pengana Hedge Funds, and Chris already had a separate listed company called New Privateer. And effectively, we recapitalised this company called Pengana Hedge Funds. We took over the structure. It had $30 million of cash in it, and we raised another $70 million of cash. And people like James Packer and Naomi Milgram came on board as cornerstone investors, of course, with Chris and myself and New Privateer. And we kind of passed around the hat, and we raised $100 million to set the business up in 2006. And we raised a closed-end fund, which was called the Magellan Flagship Fund, a listed investment company. It's now called MFF Capital Investments, and Chris runs that to today. It's done terrifically well, but that was our first funds under management, $370 million, and we raised $100 million to set the firm up. So in a period of 6 weeks in sort of the third quarter of 2006, we had 4 people in a serviced office, and we went out and passed the hat around and raised $500 million, or just south of $500 million. We have to remember that was 2006. And everyone thought we were going to set up another investment bank, and Chris and I were going, we're telling people straight that we're not setting up an investment bank, where we want to set up a funds management business.
And they were obviously receptive of that because they've handed over a few $100 million.
Yeah, well, look, we knew how to raise money. We came out of that, and we had some reputations for the careers we had had, and we knew a lot of people, and but we were very fortunate, and we were fortunate the timing of when we did it. It may be fortunate or lucky.
Not long before the GFC.
Well, not long before. When we set up the Global Fund, we launched that on the 1st of July 2007, and markets last peaked in October 2007. 2007. Of course, they really started their correction in September 2008, but it wasn't that long before the peak of the market when we really set the business up.
So describe the depth of the GFC for you and the business more broadly. And reflecting back on it now, some of the lessons learned perhaps, were there any that you can draw on now?
Yeah, I think it really came out the importance of downside protection at the end of the day, and what that creates for you in the opportunity. We beat the markets by 20 percentage points in those days, and we had a philosophy around capital preservation, and we had done some certain things in the strategy leading up to that, and we'd gone to some cash in the strategy in that. But really, it gave us a wonderful opportunity during the GFC to really take advantage of the situation, and we had some firepower to put to work in early 2009. So the first lesson is capital preservation really matters. At the end, it was a core of our philosophy, and we added some elements as we saw how things correlated to what we'd have to do additionally in our sort of risk management framework inside the strategy. And the other one was about being in business. We had $100 million of capital at the time when the GFC hit. We weren't making any money, and it wasn't pretty in terms of the business point of view, but the fortress balance sheet we had meant we could go through that period without a lot of concern. Our share price got down to 34 cents. And there were 3 buyers at 34 cents or 36 cents. I subsequently found out one was myself. I guess I had no choice but to buy. And the other 2 people I found who bought were my mother and my mother-in-law. So
the faithful.
so maybe the ultimate sort of faithful people there. But we were never worried about going out of business. And we have a very, very strong balance sheet at Magellan. We have an aversion to have any debt. And I think leverage is, I have an aversion personally to leverage, and there were some real lessons of people who got taken out. Had they not had leverage, it all would have been fine in the end, but leverage just takes you out of the game at the wrong time, and so that would be another lesson.
You've touched on the investment process a little bit there. Why don't you give us the 30,000 foot view, if you like? What are you looking for when you search out these long-term opportunities, these macro, these thematics, these opportunities that you're seeking for the fund? What is it primarily that you're looking for? And then maybe you can distill the universe down into more manageable process and list that you work from.
Well, you've asked to start at a high level, so let's start at a very high level. Before we get in the macro and why the macro comes into the process, the very first thing we're wanting to do is to invest in a concentrated portfolio. Let's call it 25 names. I call it a football team of the world's best businesses. So we want to invest in businesses that earn high returns on capital, high returns on incremental capital, and have very durable and long-term sustainable competitive advantages, or what Buffett would refer to as an economic moat to them. So we have a number of different sector teams, how we organise our research. We've got a global franchises team. You could think of a Nestle or a Coca-Cola or a Yum Brands or a Starbucks fitting into that world. We have a global financial services team. You could think of the big banks of the world fitting in that. You could think of the card payment networks fitting into that. You could think of stock exchanges and rating agencies and like businesses fitting into that world. We've of course got a technology, media and communications team. People may have noticed we've made some technology investments over the last 5 years. We've got a very, very specialist team, but it goes across a whole series of things from semiconductors to enterprise software, some hardware, some advertising platforms would sit under that space. Communications infrastructure would sit after that. Some media, very selective media sort of organisations, most of that's unattractive to us, would fit. And of course we've got our large infrastructure capability and business that Gerald Stack has done a terrific job in that. And really what we do is we identify from that universe is really what are the best businesses. And then our job is to have our analysts value those businesses. And out of that, we will select a concentrated portfolio at the best prices we can. So the core is a concentrated portfolio of just truly outstanding businesses in the world with high returns on capital. And it's very important why we're there, because if you believe in the magic of compound interest, you want to compound with two things. One, you want to have some growth behind you, and we'll come on to macro. And the second thing is you want to have high returns on capital. And they only really exist in these really outstanding companies. And you want that to endure for long periods of time. If you think of how the magic of compound interest works, and we're in a very unique, a truly unique universe where we're shopping in. And you can only get excess returns in that because most of the world knows these companies are good businesses. The only way you can get excess returns in that space is in by concentration of having a very focused portfolio. You asked a question on macro. There's two elements on macro that then get fed into our process. One is something I call macro event risk management. So are there some very profound things going on in the world that could cause a major market correction or something to happen? And we've done a number of things over the years. Before the financial crisis, we were warning people there was a very material risk that a major hedge fund or investment bank would go down with a prime brokerage run, and that's what happened with Bear Stearns. We were very early out of the gates what was going on in the European sovereign debt crisis. We've been navigating around the tightening of monetary policy in the world, sometimes very successfully and sometimes too early on that topic. So that's really sort of risk management, and then we use our sort of cash to move around some of those events to change the risk ratios we use in the portfolio. And the second part of which you're kind of almost asking a thematic question is that is growth at the end of the day, and you really want to be investing where the winds are blowing. If you can find businesses, particularly in the world we're in, and we could talk about interest rates, it's a very interesting question, but if you can find businesses that have high returns on capital and could grow at least 4% a year for the next 20 years, they are incredibly valuable compounding machines. If you could find them growing at 6% a year, hold on to your chairs if it lasted for 20 years. We've owned Yum Brands that it's been growing at sort of 10% per annum, and we've owned it for 12 years now, and we've made over 7 times our money in Yum Brands. It's slightly more than that if you take the spin out of Yum China. Visa and MasterCard, we haven't been in quite as long. Again, we're up at around 7 times our money on Visa, and they've been growing at sort of 12% a year. So we're really trying to find the sort of the long-term structural growth stories. We've been very big on payments, as you know, in the world. So we spend a lot of time thinking about really where are those next areas of structural growth in the world, and where are the businesses that have deep competitive advantages in that space. And the game's got even more interesting with what's happening in interest rates.
And that is a perfect segue into the next point, which is you mentioned briefly there the process when it comes to valuation, and I've read before that some of the discounted cash flow analysis, the DCFs that you do, often the length of these forecasts are quite, well, I'm going to say they're a lot longer than I've seen before done in practice. And then that obviously brings in interest rate risk and how you think about that in terms of your valuations and your modelling. So perhaps you can guide us through your valuation process or what your analysts would do, and then where you think or how you think that impacts valuations more broadly, but also for you here at Magellan.
Yeah, well, we've obviously got a large analytical team. We've got about 30 analysts at Magellan, and they don't cover a lot of stocks. An analyst may cover 5 to 8 stocks only in what they do, and they build very, very detailed financial models, and it's all done under a very consistent framework and modelling that we do. And the analysts do all their own earnings projections. We obviously do a lot of sensitivity analysis on that in terms of the valuation. But the interest rate is, and I must admit, I don't personally need, I look at the value and I go through all the assumptions, but for a very, very good business, I can pretty much calculate the DCF in my head.
Yeah. Okay.
I don't need a very detailed financial model if I understand the economics and what on average the growth profile of that business. That's a really hard thing. Trying to predict what the coupons are going to be from an equity bond, that's the hardest thing. And they're actually more predictable in really high quality businesses than they're in low quality businesses. And when this topic on interest rates, and the reason why I could predict something in my head, because I understand the mathematical relationship. So let's say we have a business and we have the old world where risk-free rates were 5% per annum. You add the market risk premium of 5%, and let's say the discount rate you're going to use is about 10% per annum. That if you had a business that could grow in perpetuity at 4% per annum, that business would be worth a multiple of its free cash flow on a DCF basis of effectively 16.7 times its free cash flow. And if it was at a 5% growth rate in perpetuity, it would be worth 20 times free cash flow there. But now let's say that interest rates change. Okay, so we're still at a business, exactly the same business, something we've predicted, and let's say we thought Coca-Cola for the next 20 years could grow at 4% per annum. Okay, and that's the judgment call we make in understanding the business, and the free cash flow gets closer to its profit after tax, the higher return on incremental capital is, because it needs less capital to grow, and that's why we like those businesses, because the starting point of free cash flow is higher. So let's now say that long-term risk-free rates of 4%, not 5%. That exactly the same business, instead of being worth 16.6 times free cash flow, would now be worth 20 times free cash flow. And if risk-free rates are going to be 3%, suddenly that multiple becomes 25 times. And if risk-free rates are 2%, that same multiple is going to be 30 times. So depending on the interest rate environment you're in, we could value exactly the same business between 16.6 and 30 times free cash flow. And so that's a very, very important issue and a judgment call for us to be making. I can tell you if rates are going back to 5%, these markets are overvalued. And if they're headed towards 2 to 3%, these markets are still undervalued. And it's a very interesting issue that if you can find businesses that can grow as rates come down, and a business could maybe grow at 5 or 6%, you start approaching something called the Petersburg paradox, where when the perpetual growth rate starts approaching the discount rate, you start mathematically heading towards infinity in terms of valuation of these businesses. So from a macro point of view, we're trying to do things. We're trying to understand what interest rate world we're going in, and we think it's structurally lower than it was in the past. And then we're trying to find long-term structural growth. If we can find long-term structural growth for the next 20 years of 6% a year, it is ridiculously valuable in this world of interest rates are coming down. And so that's how we kind of feed the macro. Our analysts are there to try and predict the coupons.
Yep.
The macro side is trying to value what those coupons are worth, ultimately, either to help find areas of demographics or something else that could drive a structural growth story, and therefore look at the hunting ground, but also the interest rate side is a very, very profound and deep macroeconomic equation that no one knows the answer to, by the way, and we of course we run ranges around that.
For sure. So you don't use, say, a standard discount rate across all companies that you value. I suppose it's determined in part by the strength of the franchise.
Well, we're using a classic CAPM type equation. We'll use a standard risk-free rate that we're making assumption, but you've got risk-free rates of negative in Europe and Japan at the moment, and you're at less than 2% in the in the United States. We are not using those risk-free rates in our valuation models, but nor are we using 5% anymore. So let's say we're running somewhere between 2 and 5. I don't want to say exactly what we're running, and we run a range there. So we standardise that, and we standardise when you have to fade down to your cost of capital and things. So there's standard models that get run, but it's then up to the analysts to determine what the free cash flow is going to be.
One thing I like about the way you invest is your ability or your willingness to concentrate and have conviction in your positions. I believe that the fewer decisions we can make tend to lead to higher quality decisions. And one thing that I often see fund managers get wrong is the sell decision, when to sell. It's almost harder, I would say, than the buy decision. How do you think about that? What are the indicators you use to, say, monitor the economic moat, if you like, of a business, or is it a pure valuation decision?
Well, it's very clear in my mind what the sell discipline is here at Magellan. The most often reason we sell is something I call the measurement of the opportunity cost. You started out by saying part of what we do is actually have a concentrated portfolio. Sure. I tell our team what we're trying to do is we're trying to build the world's best sporting team. I actually have 2 different sets of players. I invest in a very, very defensive portfolio, things that will be very resilient if the economy's turned down, and then a probably more cyclical growth portfolio. So let's say I've got an offensive team and a defensive team, and I say I've only got 25 slots. So I have to keep optimising. And when the analysts come up or our research comes up and finds me a great new growth business or something, and I'm going, well, I'd love to buy it. And I go, well, the team's full. So most of the times to buy that, I'll have to kick something out. And the very interesting thing of the analogy to a sporting team is, unlike a coach who's trying to win a Super Bowl or something, is we have no salary cap. We can put the very best players on the paddock, and we aren't the one who has to just buy the whole lot. We can buy a fractional interest in the very best players, and we can trade them with almost no cost. So the number one reason we're selling something is we've found a better player to put in our team, and we force it out. That team that may have no structural problems in the long term. It's just its risk-reward equation is less than the one we've found, and that's most of the reason we sell. The second reason we sell is just on an absolute valuation equation. Let's say we haven't kicked the player out, but we've held it for a long time. It now gets to a price on our central estimates, we just do not think we're going to get an acceptable rate of return on that. So absolute valuation would be the second one. And the third one, unfortunately, does happen. It's when we make mistakes. And it's inevitable in this business that you're going to make investment mistakes. You have to deal with those mistakes. You know, wishing for your money back is not a good way of doing it. Doubling down and catching a falling sword is not a good way to deal with a mistake. I think we tend to be very brutal when we make a mistake. We tend to take ownership of it very quickly. We tend to be very public, internally and externally admitting what our mistakes, and then we tend to deal with it. And you know, outside the Tesco situation, which I held and then sold, and back to turn around, and as Buffett says, turn around seldom turn. And maybe we got lucky in the end. It was a pretty average decision. It worked out okay. I probably got about 7% per annum out of a Tesco hold decision. But most times when we make a mistake, we deal with it and we sell it.
I think you mentioned Tesco in the 2018 annual letter that you wrote, and you were very candid with your mistakes that yourself or the team have made. How about when it comes to risk management? You've talked about selling these businesses, but do you implement any type of strategy? You've mentioned you've got your defenders, if you like, and your attackers, your growth and your defensive. Do you implement any other type of, portfolio management overlay? Is there a particular structure you use when it comes to building out the portfolio and thinking about it from like a low beta point of view or something like that?
Yeah, we do a series of things. You know, capital preservation. We've gone out there on a limb and saying we want our strategy to have materially less drawdown risk when markets go down. And that's a very, very important element of that. And if you're going to say that, you need to have some elements in your portfolio construction, your risk management. We're not out there shorting strategies and taking complex derivatives trying to take out downside risk. We do a whole series of steps. First of all, we're investing in a very, very high quality portfolio of businesses, and half of that's going to be in cash or very defensive businesses that tend to do very well if the economy turns around. So structurally, half of our portfolios in that area of very high quality. Of course, we then do valuations. We want to buy these when we think they're attractively priced, where there's some margin of safety involved. Then we've got something that we have, which is called the combined risk ratio. And that's an analysis of both the volatility of the stock relative to the market and its drawdown, the stock's performance during 15 drawdown periods historically. We measure of how the stocks have actually performed in the past when you get a shock in the market, and we set that combined risk ratio at 0.8. So effectively, we would say that our portfolio at its cap has risk characteristics of about 80% of the risk of the market. There, and then we, as we build a portfolio, we think about correlations and aggregation risk, and so we've got a whole series of total single stock limits, sector limits, where they correlate together in the portfolio, then to make sure that we're not overly exposed in one particular direction.
It's the proof is in the pudding, at least historically, from what you've produced here at Magellan. Top quartile returns in the top quartile, I guess, for that risk management process that you go through. And
I'd be very disappointed if we were top quartile.
Oh, sorry, I mean bottom quartile, but top quartile performance. So, I
like being a top percentile rather than top quartile, but
maybe, yeah. Well, I mean, needless to say, it's been very impressive to date, and that brings me to my next point, which is you've grown Magellan into a fantastic business. It's clearly one of the behemoths of Australian funds management. Can you keep investing the way that you do if you keep growing the way that you are?
Well, if you think about our global equity strategy, we have at the end of 2017 effectively closed it to new institutional clients. So we have about 60 billion Australian in funds under management in the global equity strategy, and outside our sort of retail business, which effectively almost offsets any sort of natural attrition we get on the other side of the book. For all intents and purposes, we've closed that. We've closed the global equities outside the retail business in Australia. Our infrastructure business is not closed, but it will close as well. Does that stop the business growing from a Magellan point of view? No. What we would say is if we can continue to generate very acceptable investment returns, and let's say on average between infrastructure and global, net of all fees, we can deliver 8 or 9% per annum in that strategy. That means every 8 to 9 years we would be doubling funds under management, yet not taking any new clients on board. And if we can grow our revenues at 8 to 9% per annum, and I talked about the Petersburg paradox here, and we have a free cash flow yield, which is our dividend yield, of around 4%, that's around 12% per annum. We don't do anything else in our business. Am I concerned with the amount of money of $60 billion that we can't generate alpha with $60 billion? I'm finding no issues with that at the moment in terms of what we're doing within our universe. And frankly, what will happen is all these companies we invest in, it just inflates. So our universe effectively stays static with markets growing and the profits of these companies growing over time. And then from a Magellan perspective, there's incremental things. We're probably going to announce a retirement product at the end of this year. Hopefully, obviously, working through some pretty complex issues, and it's been going on for a few years. We've got our sustainable strategies out there, and if we and infrastructure is not closed at the moment. If we can own a point or two of funds under management growth, 1% of funds under management is $800 million. But if we can grow at a few extra percent a year, a few $1 billion a year of new funds under management, you add that to 12%, you're up near 14% total return. So no, from a Magellan point of view, I'm not concerned, and from the strategy point of view, of effectively when we closed the core global strategy to institutional investors, I'm very relaxed around those numbers. But we couldn't have taken in 100 billion of funds under management in that global equity strategy. Okay. So there absolutely is a cap that you have to think about in terms of liquidity in order to generate alpha in what you do.
Well, I guess a lot of the names in the portfolio, particularly when you concentrate, are quite large. The Visas you've mentioned.
We only have one substantial shareholding.
Right.
In that, and that is Yum Brands. So Yum Brands is the only company where we own just over 5% of the of the company. So compared to most fund managers you look at, and I think the next biggest ones we've got HCA's around 4%. Most companies we invest in, we don't have anywhere near 1% of the issue capital. We're fishing in a very, very large pond.
Yeah, plenty to go. Okay. One of the things that you're known for, Hamish, is your ability to think what's going to happen next in the global world of technology. How is that landscape changing, and what should we expect? So I think it'd be remiss of me not to ask you, what are you most excited about as you look forward from now in terms of the technology landscape?
Well, I think we have to distinguish between what I'm excited about as a human being of what can happen and what can happen for my kids and grandkids, and what even may happen in our lifetimes in sort of healthcare and other matters, to what's probably nearer in the investment universe. And the investment universe is both things that are very positive, creating the tailwinds where we may be investing, and things that could be deeply disruptive to other areas we may invest in. Still, if we have a look what's going on in that advertising space, there's still huge unmet markets, obviously with a lot of regulatory risk at the moment. Cloud computing is something that I think is in its very, very early stages, and the size of the addressable markets are probably in the $1 trillion sort of level, and there's some very, very large players who are going to effectively own the world's computing infrastructure. And there's probably only be 4 players, maybe a player out of China, and maybe 3 big players in the West. And we're very, very early on in that side of things, and that's growing at around 50% a year. At the moment, it's obviously going to slow down. There's laws of large numbers, but we're very, very early on in the penetration. And even when it ultimately ends taking market share from sort of on-premise infrastructure, that could continue growing in line with world GDP, which is a very, very rare commodity ultimately. So that's something that there's other areas that I'd say we're early stages, but could be absolutely breakthroughs in the next 10 years. Quantum computing would be an area that I think will be a game changer in terms.
Can I ask you how so? How do you think that concept is totally unfamiliar to me? So. Quantum computing.
Well, quantum computing is effectively using quantum mechanics so the moment computers are all on-off switches on a silicon semiconductor infrastructure, where quantum computing is effectively where the on-off switches exist in the same state simultaneously. The laws of quantum mechanics, which means the computations that a computer can do are orders and orders of magnitude beyond what any form of solid state semiconductors could do. And with that, we could model out any molecule in the world and understand how it operates. We could really get into genome sequencing and really start to understand the human genome. In cryptography, you could break any cryptography in the world. It's quite frightening for which company would get, which country could get there the first. Of what you could think about writing in sort of computer programming and understanding how the complexities of the world work and break through new medicines and things that the mind can't even think about at the moment. And I think we're probably maybe 10 years away from having a functional. We've got sort of non-functional quantum computers out of labs at the moment, but a functional quantum computer and then accelerating of our understanding of the universe and our understanding of molecules and medicine and mathematics here, purely what computers don't have the grunt to do at the moment. So, and there are a number of companies who have got very, very deep research. I would say the leader is probably Google at the moment in terms of private enterprise. IBM's got large labs. Microsoft's got large labs. We've got large university labs in Australia, University of New South Wales and University of Sydney and universities around the world. So there's massive research going into this. Into this area, but it's not just technology. The reason we're not just investing in technology because it's technology. It's because of the business models that have been created and the structural growth as they start disrupting industries and taking massive market share. And it also starts getting us thinking about areas which we may want to avoid. I'm pretty sanguine about investing in banks.
Okay.
I think we're at the front end of their business models being disrupted. Obviously, we've seen what Facebook announced the other day with Libra, but you're going to get huge amounts of financial disruption in the banking system if we look at a decade. If you look at the power of what Amazon's doing in the world and what Facebook's doing in the world, the ability of new brands to come up and get distributed in completely new ways, traditional brands start getting disrupted in the world. So we think on opportunity and risks on the side of what technology can enable.
It sounds like that the quantum computing might be the personal excitement still being 10 years away, but it's kind of like the optionality of owning Alphabet shares, for example.
Well, you could have the optionality of owning Alphabet or Microsoft, for instance, but closer to home is there's three big players in the world who own the cloud computing infrastructure of the world. One is Amazon Web Services, and we don't own Amazon, but we own large positions in Microsoft and Alphabet. Microsoft owns the Azure platform, and the Google Cloud platform is obviously owned by Alphabet. I would say that's nearer term in terms of what's going to be very material in their profitability in the next 10 years. I don't think quantum computing is going to be material to any of these companies, and it's very hard to predict who will have the winning quantum computing sort of infrastructure in the world. But I'm saying for humanity, breaking that equation and what it opens up is profound.
Okay. Well, it's something to look forward to with excitement, I guess. You've mentioned the big US names here. For Australian investors sitting at home or in the car listening to this, and they're thinking, I don't invest abroad, I don't have that exposure, I would imagine that you would say that the home country buyers, if you like, they're going to miss out over the next decade or longer.
Look, I don't want to overly talk our own book. Obviously, I've got a slight conflict of interest, but I think the simple math of is, the Australian market represents less than 2% of the world's market capitalisation, and therefore if you've got 70% of your money in Australian equities, but it's only 2% of the opportunity that's available there in the world, you tend to have a home market bias, and people typically get home market biases wherever they are. It's extreme in the case of Australia. Obviously, there can be benefits with our taxation system with the franking credits you get out. So there are the franking credit equation that you get out. You don't get double taxation on ownership of Australian equities, where if you own some equities in France or the UK or the United States, you would on the dividends maybe get, not on the capital gains, but on the dividends as an element of double taxation there. But if you really think about what's going on in the world and you want to invest in areas of structural growth, where are the areas? The banking system, I've just said, I'm not interested in the bank. The retailers, most of the retailers, there's probably only traditional retailers, there may be only 4 structurally advantaged retailers left in the world. And they ain't in Australia.
Could you name some of them? Or?
I would say Costco has a structurally advantaged retailing model. Maybe Inditex, who owns the Zara business, maybe have a structurally advantaged retailing business. Walmart, I think the jury's out whether they have the capability to effectively take on Amazon or not in the world. A lot of the traditional retail models are structurally really challenged about what Amazon's doing to the world and the physical nature of the real estate burdens that they that they have whole paradigms are being shifted. So then you say retailing's not that attractive. We have a large commodity sector in Australia. I'm not huge fans of commodities, but that's it. But where are the payments franchises? Where are the cloud computing businesses in Australia? Where are the access to the non-commodity side of China? I guess we've got A2 Milk or something, but where are the luxury companies that you could participate? What is going on at the upper middle class and the prestige side of the Chinese market is growing at 30% a year at the moment, and it's by far and away one of the large structural plays that's happening in the world. We obviously own Starbucks, and we may own some other things now that's playing into that. It's just, when you look what's going on in the world at the moment, there are very, very few players in Australia that are listed that you can participate in that, and they're kind of playing out in the old economy, and much of this old economy is being hollowed out.
Yeah, I've heard you say that before.
Yeah, I think I've said before that the centre of the market risks being hollowed out, and I think it's true. I really think the disruption that's coming is hollowing out those traditional businesses in many stock markets in the world, and I think Australia really looks like that to me. But there are some good companies here as well. So I don't want to say there aren't good companies. It's just the game's got harder, and there's fewer choices here. And the game's got harder for all of us.
And if you're picking your best 25...
It's just I've got a larger menu to select from as that world starts to get hollowed out.
For sure. There's one final thematic, or maybe we can call it a thematic, is this Trump v China or USA v China trade war. I know you've shared some thoughts on it before, so I'm just interested to get your latest thoughts on it, how you think that's going to play out, and any implications for you here at Magellan.
Yeah, well, first of all, I would say that in the long-term strategic or geopolitical struggle between China and the United States are not going to get solved at the moment.
Okay.
The only thing that will get solved is whether there's a truce or not in that, and that is really a political issue for Trump to decide domestically of what he wants to take into 2020. Does he want to take in the fact that there's a massive fight between China and he's fighting for his base against China, or does he want to take in the stock market and he's the world's greatest deal doer and has just done the greatest deal in history? And both of them are viable political platforms to take into 2020. So if you think about the short-term issue, is we could either get in a deeper trade dispute and Trump decides not to take off that table. That is probably pretty ugly for markets in the short term, because most markets are factoring in that there will be some form of truce called in the short term. So we think about the short-term risk in terms of escalating tariffs or not, and how we'd be exposed to that issue. But the very long-term issue is, I've already talked about that getting China right is incredibly important for investing over the next 10 to 20 years. But we can't ignore that there's going to be this ongoing geopolitical tension between China and the United States. It's not going to go away. So we really have to think about how do we participate in that growth in China without putting too many eggs in an American flag around that. We own Starbucks. We own Apple. We're not buying Apple because of its China business, but it's got its supply chain in China, and 20% of its revenue coming out of Greater China at the moment. When you think about Starbucks, about 50% of its profit growth in the next decade is going to be driven out of China. So it's an important issue. But if we're wanting to participate more in that structural growth of consumption in China, and it's a very, very important issue, and we don't think that's going to go away with the trade dispute. We think China is going to continue to grow. We'll have cycles, but it's going to continue to grow, and particularly at that high end. How do we participate in that without overly correlating this risk around this ongoing tension between China and the United States?
Yeah, okay. As we come to the back end of the conversation, I've got a few more questions for you, but one of them is just to ask you how our listeners can find out more about Magellan and the funds that are on offer. I know there's some listed on the ASX. Is the website the best place to go?
Yeah, I think the website is the best place to go. We feel very, very strongly that we want to provide all the investors with the same information to make a decision to either invest in Magellan Financial Group or invest in any of our funds. So we put a lot of material on our website, both in written and video form. There's lots of fact sheets. There's daily prices on all our funds. There's descriptions on that, but also our views on companies and our views on what's going on in markets. We put that on the website, and we really hope that people find that insightful and useful for making a decision whether they want to invest with us. And of course, people can go and speak to financial advisors. You know, most financial advisors would be well versed in what we do as well.
Great. I'll put all the links in the show notes for those. Second last question. I just want to know, perhaps a selfish one, how your life has changed since you started Magellan. Yeah,
to be honest with you, my life has changed very little since I've started Magellan. My kids are a bit older. I've got 4 fantastic kids. We have a farm out of Sydney. We owned that farm before we owned Magellan, and we built a house there. I think since we've put Magellan, we were a bit extravagant. We put on 2 bedrooms, so we've renovated. We've renovated the farm. I live in the same house in Sydney. I've still got the same car, but I bought a second car. I have a ute that I had that's on our farm that I use. But I bought a slightly more comfortable car, a Volkswagen, to drive up and down to.
Probably more appropriate around the city.
Yeah, it's a little bit more comfortable. The ute was pretty uncomfortable to drive in. So we try and keep it real at home. But I love what I do. You know. Probably what's changed at Magellan is Magellan's changed. Magellan's got a lot larger, and we've got a lot more people and fantastic people here. Magellan, after a decade of One Castle Race Street, we moved into the MLC Centre. We got a very good deal on the rent here, by the way.
Okay.
But we've got some nice offices now. They're not over the top, so maybe that's changed a little bit. But literally, we had people stacked on top of each other down in one car. When you set up a business with 20 people and you end with 100, it gets a little cramped. I think we had 1 or 2 meeting rooms. So, you know, it's got a slightly nicer, but really from my life is, and I think that's a really important lesson. I think you notice people who start having success and then they start changing their lifestyle to mould into that, and then the things that made them successful all start to disappear. You know, their focuses change and what they're doing changes. And, you know, I'm not doing this for the money. I do it for the game. I love the scoreboard. This game is very, very humbling. I can tell you, every time we make a mistake, a lot of competitors and journalists and other things point it out very quickly. I don't mind that. I don't mind that. If we make a mistake, we deserve to be called out on that. You can't reinvent the scoreboard here, and it's a journey, and we're doing it for the long term. You know, I've got no intention of sort of retiring at the end of that. I'd love to do, you know, Warren is 88, he's going to be 89 next year. Charlie's 95. I'm not sure I'll still be doing it at 95, but I look and say there's a lot of water to go under this bridge.
For sure.
Yet.
Yeah, for sure. Okay, last question, Hamish. It's my favourite. If you could go back and tell a younger you, perhaps even your kids today, one thing about money, finance or investing, what would it be?
I think the most important message I'd have to anyone is compound interest at the end of the day. And I just love the quote from Benjamin Franklin, one of the founding fathers of the United States. And he said, money makes money, and the money that money makes more money. And really that's the core of what investing is all about, is finding a great investment and having patience and letting that magic work for you over time. And just not trading in those chips quickly. And that's really what we're about at Magellan. If people could understand the mathematical relationships of compounding, If you've got a business, if you've got something that could compound at 10% per annum, that means every 7 years you're doubling your money, and over 14 years you've got 4 times your money. Over 21 years you've got 8 times your money. For 28 years you've got 16 times your money at 10% per annum, and you change those compounding rates a little bit more alpha, and the numbers start to explode. And just understanding it's a game of patience, and it's a game of finding where you can, in a low-risk way, compound your money at sensible rates. So they don't have to be at ridiculous rates. It is much more valuable finding something that can compound your money at 15% a year for a decade than something that can make you a 50% return in the next 18 months. And I don't think a lot of people get that, and that's probably... Look, I like math early on, and I kind of got mathematical relationships, but if I could tell one, people just look at compounding tables and understand them. And once you understand that and then have some patience, that would be the biggest lesson.
Wonderful, Hamish. Thanks for taking the time out and joining us on the show.
A pleasure.